Hi everyone, I'm Realtor Jacqueline Lyday here with the Lone Wolf Eric.Becerra. Today we're following up with our last Zoom regarding the Dream for All shared appreciation loan. All of the details were released as of the 27th. So Eric, give us all the information, give us a scoop.
Yeah, let's go ahead and just jump into it. I know you might have some questions that we can help
Yes.
other folks that answer as well. But just it's important for us to understand, number one, what's the definition of a first-time home buyer, right? And that is somebody that has not owned a home, has not been on title on a home in the last 3 years. That means that if you owned a home in the past, you may be eligible to qualify for this program.
That's good to know. Thank you. And then you said the same with if you are married and you have a spouse, you are not eligible if your spouse has a home, correct?
If your spouse owns a home, you may qualify. You may be eligible on your own to purchase this property if this is your primary residence. So the program, yeah, is for first-time home buyers. What it's doing, it's helping people with 20% down. Now, you can use for 20% of the funds for down payment. And
Okay.
what's really cool about that is that it can eliminate the PMI insurance if you do that,
Nice.
right? So you can save some money right at the back if you use it completely towards the down payment. You also can have the option of using part of it for down payment and another part of it for closing costs, so that it can help you come in with very little to possibly no money down whatsoever. For
Nice.
example, if you came in, let's say, with about a 17% down payment, you have a small PMI, right? Because you didn't put the full 20% down, but use the remaining 3% towards your closing costs. Okay. So, for example, on a $300,000 house, 20% of that would be 60,000, right? However, if you went 17% of that, right? So is basically it's $61,000. The other $9,000 would be able to apply towards the closing costs, the
Nice.
3% that remained over, right? So that's number one. We're finding that we're helping people eliminate PMI insurance and come in with very little to no money down.
Could you give us an example of the amount of a PMI payment?
Yeah. So typically for first-time homebuyers, if you're coming in with 3 to 5% down, that PMI payment can vary anywhere between $30, $40, $50 to $180 to $200 plus,
Okay.
depending on your purchase price, right? So you can potentially save, a couple $100, depending on your price point in PMI.
Nice. And
And
PMI is,
private mortgage insurance, right?
thank you.
And remember that PMI doesn't benefit you, the buyer. It benefits the bank in the event that you default because you didn't put 20% down, right?
So you're paying the bank's insurance if in case you default.
Correct.
That's good to
Correct.
know. That's good for
Yeah.
people to know out there.
Yeah. Now, some people will avoid paying PMI like the plague. And I got to say this: we have to look at PMI like a tool, not so much as something that's negative towards it. Because many years ago, without
Mhm.
PMI, you weren't able to buy a home if you didn't put 20% down. So it's actually there as a tool to help folks get in to buy a home with less than 20% down.
Thank you for
So
explaining that. So in a way, the more risk for the bank, the higher the PMI.
that's correct.
Okay.
Yeah.
Thank you for explaining that.
So if somebody bought a home for $300,000, right, and instead of putting the full 20% down, which is $70,000, right, they put 17% down, then 3% of that can be used towards closing costs,
Oh,
right? So
wonderful.
then again, yeah, so therefore it gives you the opportunity to have little to no money out of pocket. You have a very small PMI insurance, as we talked about, and maybe it's $30, $40. And not to mention, it will allow folks to remove it usually after a couple of years, and the appreciation in the home will most likely come really quick, so that money can drop off. The very little that's left there can drop off after 2 years. So huge benefit there.
Wonderful.
Um, one of the ways that I'm seeing huge benefit here as well is, for example, if you were pre-approved for a $350,000 home, right, is of course it's going to drop your payment. You're going to save hundreds of dollars in payment, right, your monthly mortgage payment, because you're going to base your mortgage off the $280,000 loan versus a $350,000 loan, right? So there's a big benefit there in what you're going to save. The third big benefit that I see also is it's helping people push into a higher price point, a higher bracket that they otherwise couldn't qualify for in the past. I just last night, somebody that I had pre-approved for $400,000, right, was able to push them now into a $500,000 price point.
Oh,
That's a
that's
whole different
nice.
type of home, right? So,
Right.
and
Different
so
neighborhood.
the different neighborhood, different possible school district. My point is, if you previously were qualified for X, you can now qualify for Y, right? So this $500,000 house is actually going to they'll only have to pay a mortgage on a $400,000 loan, right? So this is one of the other great benefits that I've seen that's helping a lot of folks, again, not just save money, not eliminate PMI, but helping people increase their purchase power. One of the basic requirements is that you need to have a 680 FICO score. That 680 FICO score will allow you to qualify up to a 45% debt to income ratio. Okay. If you have a 700 FICO score or above, you can qualify to up to a 50% debt to income ratio.
And can you give us an example of debt to income ratio for anybody out there that doesn't know what that means?
Absolutely. Great question. So the debt to income ratio is what we use to help qualify. What we do is get your gross income, right? And we divide your debts, your total debts, your car payments, your credit cards, and your mortgage payment. And we divide that by your total gross income to give us what we call a DTI, or debt to income ratio. So for example, let's just say you have a $500 car payment, you have $500 in credit card payment, and then your new mortgage is going to be $2,000. Right? That's $1,000 in debt plus $2,000. That's $3,000. Right?
Right.
So in order to qualify for a home without that debt at 50% debt ratio, you will need to make $6,000 in gross income.
And
right? The
before or
3,000
after taxes?
This is before taxes, your gross, right? Yeah, it's a good question. Yeah, 3,000 divided by 6,000 would be 50%. Okay. One of the things that we found in this program is that the income limits, they're very flexible. In the Central Valley, for most of the counties in the Central Valley, they go up to $159,000 in annual gross income. If you're in a high cost area, it goes up higher. I believe right now on the coast, some areas are over 200,000. Santa Clara County, $300,000 gross income is what they're allowing.
And that's combined if you're married, correct?
That's correct.
Okay.
Yeah, combined, whether you're married or not married, but if you're applying with a co-borrower, that would be your combined household income.
Okay. And my second question is, what if a spouse is purchasing a home on their own? Does their spouse's debt count against them?
It does not, because this is a
Wow.
conventional loan. It does not count against them. So yeah, we would only be looking at their debt and obligations. One of the other key factors is that this is a loan, right? This is a 0% interest loan. So there's no interest that's accumulating on the loan. So in that example that I gave earlier of somebody buying for $350,000, that $70,000 loan that you got from CalHFA does not accumulate interest. Okay. The only way that, the way that CalHFA and the agency is going to get their money back is going to be in the shared appreciation, right? Which in essence is they're going to share in the equity that your property has gained. So fast forward 5 years from now, if that same property for $350,000 that you purchased increases in value by $100,000, it's now worth $450,000, right? Then that $100,000 is split up by the following: 20% goes back to CalHFA, and you stay with the 80% equity. And if you were to sell the property and or refinance it, then those proceeds of the $70,000 will be paid back to CalHFA.
Okay, so just to break it down, if you sell, this is the 20% that you originally paid. So you'll be paying the 20% you originally borrowed, and then you'll be paying the appreciated 20%. So almost like the 220s that you're paying?
Correct. Yeah.
Okay.
So the initial, you got to remember the second 20 is actually lower, right? Because it's 20% of the equity gain, right? So again, in this example, $350,000 purchase price, $70,000 is 20%, right? We'll get that back in 5 years after you sell the property, or however long it takes you, or you want to sell. And the additional 20% of the $100,000, of the $100,000 that was earned in equity also goes back to CalHFA, right? So a lot of people say, well, what's the catch? Well, that's the catch, right? I like to say, 100% of zero is still zero, and 20% of this is actually something. In fact, they're gaining 80% in appreciation, right, as a homeowner. And so now the other question I'm getting is, what happens if my home does not go up in value. There's a good chance that can happen.
That was what I was going to ask
Um,
next.
yeah, so the guidelines state that if it does not go up in value, then you do not, other than paying back the initial 20%, there is no shared appreciation. There's nothing more to pay back to CalHFA.
Okay. And this
Yeah.
happens whether you refinance, add somebody to title, or sell. Is that correct?
Yeah, change the title, you refinance or sell. Now, there is a caveat, which is actually, I love that they did this because they also thought about this. In the event the interest rates, let's say, drop and you want to refinance just your first mortgage, they're going to allow for a one-time subordination. What that means is that you will be able to refinance your first mortgage. Let's say interest rates drop to 4%, four and a quarter, and you want to, but you're not ready to pay back the 20%, right? And the appreciation, right? You can refinance just that first mortgage alone by itself and subordinate, meaning keep that second mortgage, the money that was lent to you, it remains there in second position, which allows you to complete the refinance and take advantage of the lower interest rate and lower payments.
Okay, that
So
makes sense.
yeah, so that's a very good benefit, very good feature of the program that is going to allow a lot of folks to take advantage of future interest rates if and when they go down.
Nice. You just said that it's 0% interest. So does that mean you're paying nothing but the principal? Or what does that mean? Like
Yeah,
example.
yeah. So 0% interest on the money that you for the assistance, for the 20% on the assistance.
Okay.
The interest rate on the first mortgage today's Tuesday the 28th, the CalHFA rate or the Dream for All interest rate is a 6.375%. Okay, that's the interest rate that we use to calculate your mortgage payment. We don't know, it may be higher or lower tomorrow, so on and so forth, right? But there is an interest rate on the first mortgage. The second mortgage, which is the assistance that's provided for the 20%, is 0%, and it will accumulate zero interest.
Thank you for clarifying that. Another
Mhm.
question that I just had was, if you have an 800 credit score and you're qualifying for this program, will you still have the same interest rate, that's 6.375, as somebody who's just scraping the 680 mark?
Yep, good question. You do. It's one interest rate for the whole program, no matter what your credit score.
Thank you. That's really good to know.
I think that you have to be comfortable and have to understand truly what really is involved in you getting this type of assistance. This assistance is not going to be for everybody. However, um, most people do see the benefit in the shared appreciation. Most people have lost hope in the past. Recently, they weren't able to buy a home. They were saving money. They were trying to save money for a down payment, couldn't do it. Even scraping sometimes 3% or 5% can be tough, right? And so this is what I love about this program, is that it's given hope to a lot of families, a lot of folks that in the past wanted to buy a home, but the only thing that was holding them back was a down payment, right? And so there's a huge opportunity for a lot of folks. Because of the popularity of this program, there's only $300 million that are allotted for this program. So there's
Wow.
a limited amount of funds, which means that the money is going to go quick. The last program that CalHFA had was called the Equity Builder. I want to say funds were limited within a month or two. We foresee that only about 2,500 people might be able to take advantage of this program. There's a lot of folks in California, right?
Right.
And so there's millions of folks that want to buy a home. And so if you are interested, I say don't think about it. You need to figure out if you're eligible, qualify, and let's figure out if you qualify for the program. And let's get you into and let's get you to start the process right away, because again, it's going to go based off of reservation. So you have to be in contract in a home to be able to reserve your funds and you lock your rate. So you got to make sure you're qualified. Make sure you gone out and you got into contract. Right now, that can be tough depending on your price point, as you know, Jackie. There's a lot of multiple offer situations right now. Because of this program, I believe there's also going to be another huge influx of buyers in the pool. That's going to make it even more difficult. That's why we have to start quick, and we have to be persistent. You have to get with the excellent local real estate and mortgage team. That knows the market, like Jacqueline, exactly. That knows the market, that knows how to navigate and negotiate on your behalf. Very important. It's important to work with a local lender. Why? Because local real estate agents that are listed properties want to work with local lenders to know that they can be accountable. They can have clear communication and know that they can perform and close on time when needed.
Speaking of lenders, Eric, there's only certain lenders who are qualified to do this loan, correct?
That's correct. So you have to be certified and approved through CalHFA to be able to do this loans. And there could be a lot of people, also a lot of lenders that they're approved to do the loans. However, not everybody is as experienced in working with CalHFA. We do all the paperwork for you. We submit everything for you. We get you approved. We do all that, all the heavy lifting for you, so you don't have to go and try to figure it out on your own.
And there's a class that people have to take in order to be eligible for CalHFA, correct? So there's some education that needs to happen in order for this to move forward.
There's actually two classes with this specific program,
Oh,
right?
wow.
They have to,
Okay.
yeah, they have to take a first-time home buyer class, and somebody also has to take. If there's two people on the application, at least one of them has to take a class on the shared appreciation portion, so that way they truly understand, the way it works and what's entailed, right? What's at stake here when you're giving up some of your equity.
Does it matter if you sell your house in 5 years or in 40 years? You still have to pay this back, correct?
That's correct. So one of those, I had another question was, what if I pay off? I never sell, I never refinance, and after 30 years, I finally pay off my loan. I have a 30-year fix. What happens then? Yes, it has to be paid back at some point, or once the loan is paid. So they will want their 20% back at some point.
All right. Well, it sounds good to me. Is there anything else that you want to share?
No, I would just say, if you have any doubts, any questions, reach out to Jackie, reach out to myself. I'm sure that somewhere on here there's a link to find out if you're eligible and you're qualified. Yeah, Jackie and I have been working together for many years, and so
Yes.
again, we can definitely help you out. And don't wait. Again, just you have to figure out where you stand right away.
Right. So if anybody gets any type of message from this, it is that time is of the essence. And something that one of my clients actually said yesterday that you said the same verbiage was 20% of nothing is still nothing. So
Yeah.
technically you have nothing to lose. So good information, Eric. Thank you so much.
Thanks, Jackie. We'll talk soon.
Have a good one. Maybe next week we can talk about a different loan. I'm sure there's a bunch of them coming out and guidelines are always changing. So
I'll be happy to do that.
thank you. Well, have a wonderful day and I will be in touch.
Oh, talk soon. Thanks, Jackie.
Thank you. Bye.